Well, welcome, guys, and thanks for spending the time today. I'll go through things as I see them, and then if you have questions or comments, if I gloss over something, just interrupt or ask. I don't want to keep it too formal. But I think everybody knows where to find me. But I do the it's all in the Reflexes Substack, and then I'll put a lot of my um, real-time thoughts on charts in the market in on X. Um, so I like to throw a quote in where I can, but I like this one a lot. The goal here isn't to make monumental moves, but I want to follow a discipline. I want to, do it as consistently as possible, and this will lead to, much stronger results over time. And this is what we prepare for is to evaluate market risks and signals, and then respond to them in a very consistent fashion each time. So looking at the weight of evidence approach. I still want to swap out. We'll take a look at the McClellan oscillator and summation index, and I think I'm going to swap that ultimately for the number of companies that are a number of S&P companies that are below their 200 moving averages. That's such a strong signal and a much slower moving signal. But looking at the indicators that we have now, we've got four that are in the red. We've got four that are yellow and two that are green, and some of the reds are trending towards recovery, but until they're back, until essentially I see the us out of the woods on this 5% drawdown alert, the Thrasher 5% canary indicator. That's the strong one for me, and so until I see that resolved, I'm gonna be probably biased towards more downside or more risk averse. But I don't think that we're in a situation where we'll see a long-term poor economic outcome. And so I just want to take this one very seriously because the indicator has preceded some of the worst drawdowns in market history over the last 50 years. I want to take it very seriously. But ultimately, once we see trends start to repair, I'm going to look to rejoin trend and be on the right side of continuation of the bull market, hopefully. Volatility put call ratio is gave us a really alarming signal, and I'll show that in a little bit, and then is now kind of turning back towards a more bullish environment. So I'm sensitive to this possibly being a whipsaw for us. I don't want to get caught in that, but if we get enough evidence of a bull market recovery, then that's where we want to be. And then Fabian model started the utilities index recovered last week and now is back in the red, and the Dow has recovered, and so the Dow's back above its 200-day moving average, and it's actually pretty reassuring to see the Dow recover early in this. Fisher and COPX model have stayed green the entire time, even though they're trending negatively. The equity commodity model is very slow moving, so we won't have an update on that until April. But that's still in the yellow with only one condition met: new highs, new lows versus their 50-day moving average. This is red, and this is a very slow moving indicator. We don't have very many signals on it over the last 10 to 15 years. So this is one that we want to take seriously as well, and we'll look for that to. That's a breadth indicator. We'll look for that to recover to give confirmation of a bull market. The selling climax indicator. This is now at this one's gave us a 10% signal on the 4th, and has been below 4% since the 13th with a declining moving average, and so that's bullish, and that's a good sign. Extreme vulnerability is still in the highest range since 2008, which is concerning, and this is not a very good timing mechanism. This is just a condition that has preceded really strong drawdown. So when we see that one clear, it's still pretty sketchy because it's cleared before, and then we've seen the large drawdown come like months later. So that's just a condition that we have to keep on the radar for some time until we get a very strong comfort level that we're past it once it does resolve. And then the index momentum um, on the daily, weekly, and monthly is it's still in the bearish zone on the daily, and we're like 50% bearish on the weekly, but it's trended favorably in the past few days. So it's not completely cleared, but it looks better than it did a few days ago. And then, in terms of like present conditions and economic outlook, we've got three catalyst dates, or a couple of catalysts still on the radar for this week. We have final GDP coming on the morning of the 27th, and then we have PCE coming in on Friday morning. So that's probably the economic data that we need to be most cognizant of. But the consumer confidence actually, I think we got another readout on consumer confidence towards the end of the week as well. But we got consumer confidence today, and it's a preliminary number. And then I think we have final consumer confidence figures on Friday, along with expense and savings. And consumer confidence will, it's reported more slowly, so it's not strong as like a leading indicator, but it's good for confirmation. And if consumer confidence dips too far below, then that'll be confirmation that the market's headed lower, and we don't see much divergence between consumer confidence and trend of the market. So this is a very consumer-driven economy, and so it'll be critical to see this do well. And I'll actually pop over to that chart next. Any questions from you guys so far?
Can you show us the index momentum criteria that
Which
your
one?
last slide? Like the last row that was bullish on the weekly but bearish on the daily.
Oh, absolutely. Yeah, let's go through those. Yeah, let's go through those next. And so this is let me pull that list over to the side. So here's our 5% drawdown indicator, and you can see that the S&P is back above the 200-day moving average. We'll have a lot of mention of that from analysts, and it's important to recover the 200-day. But what's really important is when we get into the chart where we're looking at the AVWAPs, we want to see those recovered, because that's what sentiment is really doing. So this one, just because we're back above the 200 doesn't mean that we're out of the woods yet. And then recovering the 5-day moving average and upward sloped 5-day moving average is very strong. So that tells us that anything that, if we were to do short-term trading, we want to do that in the direction of the 5-day moving average, and we want to buy into strength. But a declining 50-day moving average and a declining 20-day moving average are bearish. So that's a risk for us. This is the 200-day moving average, the percentage of companies in the S&P 500 that are below the 200-day moving average. And as long as that's above 275, that's bearish. So we need to see this come back down below 275. This means that 55% of companies are below their 200-day moving average. On the McClellan, this is basically every flavor of the McClellan oscillator. And so what this is a measure of the number of companies that are making a new high versus a new low. And then it's looking at that in a couple of ways. There's a 39-day exponential moving average, and then a 13-day exponential moving average. And the two of those are one is subtracted from the other. So you've got a momentum indication, and then in the oscillator, this is an acceleration measure. So it's taking the first derivative and then the second derivative. And what's not good here is that we got back above zero. So if you're to trade on just the McClellan oscillator, you're opening your trade when you're above zero and you're closing it when you're below. But the formation of these tops in the bearish state and the bullish state tell us a lot about the health of the breadth in the market. And so when you have like a nice flat consistent span above zero, that's telling us that we're leading into like, a bullish run, right? And then you get these like, deeper dives below. It's almost like inverse head and shoulders, and that's going to be a more explosive movement upwards. When you start seeing them like, the market fail early into an upthrust in breadth, that tells us that it's a little bit more bearish. And so these are exhausting early, and this has not been a very strong um, upthrust from that bullish crossover. However, um, on the summation index, we've got a bullish crossover, but it's below zero. So the summation index is still, negative net below zero, or on a net basis, like below zero, even though it's got a bullish crossover. This is an RSI measure of the McClellan summation index. It's a bit, it's leading as an indicator, but can give us some false positives. And then a MACD version of it at the very bottom. And so these have bearish or bullish crossovers, but we're not seeing a lot of strength in breadth yet. So it's um, this suggests possibly more of a whipsaw than a recovery. The volatility weighted put call ratio. Now I like this as an indicator for we get this break below the Bollinger Band and a crossover on the follow line, and that usually precedes a relatively shallow pullback. These are like, less than 10% uh, drawdowns in the market. So this is a pretty good trading signal. But when we see the volatility weighted put call ratio um, go all the way down to like negative 90, we don't have very many of these. There's like 13 of them going back to the beginning of the data series, which is like 2007. And when they do it in this fashion, where we've got like, a shorter movement that crosses below the Bollinger Band, a recovery that doesn't make it back above its moving average, and then, a move to the negative 90 level, those tend to precede like the stronger drawdowns in the market. And we've only got like, half a dozen instances of that. But these were all pretty ugly. So this is definitely cautionary, and this has a very high hit rate. So um, as a signal to protect us. So yeah, this one was definitely a little bit concerning, but it looks like it's having a bullish crossover back into its moving average. So um, we have to just be very open-minded that we could be in for a lower, a higher low scenario, followed by a market recovery if we see this, or this could be, us jumping into the moving average and then coming right back out, which is what we saw, last October, coming out of the fall and then into the October 2023 when we put in that higher low into this past bull run. So this one's a signal that we just haven't seen very often, and so we want to take that seriously. The Fabian market timing model, this is where we saw Dow utilities fail and then recover, and then the Dow industrial average dip below its 39-week moving average, and now that's the only one that's above, with the S&P trending to potentially cross it by the end of this week on a bullish crossover. So this, again, slow moving indicator, and it's favorable for us to see this one recover. The COPX and Fisher, again, this one stays bullish and green for us. The equity commodity model only has one signal that's bearish, and that's stocks below their moving average. Commodities and equities still have a favorable rate of change for this particular signal. And then the new high versus new low accumulation relative to its 50-day simple moving average. This is one that we don't see very many bullish or bearish crossovers. So this is a fairly steady indicator. The last time that we had a whipsaw was back in 2019, and when we're looking at this in conjunction with more than 10% net new lows in a day, it's a bit more reliable, and we had that in at the very beginning of the month. So we do want to see this crossover before we get too comfortable. Now we've been expecting a bounce, and we're starting to see that this week. The indicator on the bottom is a measure of absolute new highs, and so whether it's a um, bullish or bearish reading, I'm counting it the same way. And so when we get to a very extreme at each end of the bell curve in the number of net new highs relative to its 3-day moving average, we can see a bounce in the market. And specifically when it gets below 15, we don't have very many of those. And the very first time that it crosses below 15 is typically an overreaction that's followed by a bounce. And so we had that happen on the 13th, and immediately see this bounce in the S&P after that. And that bounce is, in my opinion, I think we may see that exhaust this week. I'm thinking we've got potential for that to happen on the 27th, but that's just a bias from some other measures that I'm looking at as well. And then the extreme vulnerability, the last time that it was higher than this, we have to go all the way back to 2008 to find a longer period without making an extreme low in net new lows. And then the multi-time frame. So this one I've got, unfortunately, sorry for getting to it so late after the question, but this is one that I have like just number 10 on the list. So it's further back on my in my queue. But this is where we're looking at the average directional index and the RSI, and we're doing this on a daily, weekly, and monthly time frame. And so the daily is still bullish, and RSI needs to cross above about 65 for us to regain the bull zone. Um, it looks like we're trending in that direction. We've had a bounce off of a relative low, and you've got the positive directional moving index, the positive directional index inclining, while the negative directional index is declining, and the ADX is rolling over. So this tells us that the downtrend could be exhausting, and we're getting a glimpse of that on the weekly as well, where we're seeing, the trend, the ADX is picking up, which tells us the trend is gaining momentum, but the negative directional index has rolled over, and the positive is starting to curl upward. So that's potentially bullish, but we're also starting to see that follow through on the monthly. And when it comes to primary trend, the higher time frame leads the trend, and the lower time frame, like the daily, is going to operate within that primary trend, and you'll have secondary trends or opportunities that move in the direction of the primary trend. So what our clue here is, if we will lose trend and fall into a secondary downtrend on a high time frame, then we're in for probably more bearish activity in the near term. But this RSI has held, it came all the way down to it, but it did not cross into the bear zone. That's good for us. We don't want to have we don't have many instances of it crossing below into the bear zone on the weekly level. So S&P, we've got 4 instances going back to 2018. That's just not a lot of activity back and forth. So that's good that it holds.
Can I ask you a question about the weekly RSI
Yeah,
bear
absolutely.
zone? Um, are there previous instances where it came down that low in an ongoing uptrend? Because we're like 2 years into this bull market.
Yeah, absolutely. And it's a good question, because we want to make sure that we don't want to be complacent to these things, and eventually, these lead to uh, a regime change or a shift in trend. So, like, um, too many bullish divergences in an uptrend eventually, they speak to exhaustion. So this is going to be maybe a little bit messy. Let me get to like a clean iteration of this chart. So I just adding and subtracting the S&P from itself just to give us a like a cleaner chart to look at. Sorry about this. Trying not to delete too many things from the chart. Um, so taking a look at RSI, and this is a 13 period RSI, and let's take a look at it with we'll look at log on the S&P on a weekly um, moving average. We want to do. Let's do let's do a 10-month moving average. And so when we look at look at instances where it's gone into a bearish crossover during this primary uptrend, we could say that we can consider ourselves in a probably in a strong primary uptrend since the 2020 or the 2009 timeframe. So you've got we've got this lost decade, right? Is what people call it. But you've really got, in my opinion, two opportunities for 100% return in a lost decade, and that's the importance of market timing. That's just my own opinion on it. But so yeah, we come in. Um, this bearish primary uptrend rolls over, and then we go into a consolidation with two bear market drawdowns, and now we're in a strong primary uptrend. And looking at looking at what some people say is like you want to see three touches of a trend line. Um, I think how often a trend line is touched isn't quite as important, especially when you're looking at a long time series, and this is on a log basis anyways. So you've got uh, a strong prevailing upward trend line, only a couple of like bear market drawdowns below it, and each time that this indicator goes from blue to white, we've gone into a bear market, a bear zone for the RSI. So in this primary uptrend between 2009 and 2020, you've got 11 years, and in that time frame, you've got one, two, three, a little whipsaw here is four, five, six times that we went into a bear zone in RSI, and each of those times the market did either move sideways or fall further. So there were, even though we have this whipsaw here in 2014, where we come down and we get below the 10-month moving average just by a hair. You can see we've got a trend recovery right away. We get back in there. Yeah, so there's other indicators that help us with this, but again, one, two, three, four, five, six instances in an 11-year bull market. So that's not a frequent signal. And then it signals at the beginning of COVID, and you can see on a weekly level, we're reclaiming that bull zone in the RSI, well after the drawdown. So we're going to use other signals to let us know to redraw, to rejoin the trend. But since this 2020 recessionary drawdown, we've only had three instances where it's gone into the bear zone. Now it's technically painting it as a bear zone right now. That's because this indicator paints the background a little bit differently than the one on the other screen. But it technically has not lost the lower bear level yet.
I was wondering about the context of because like you said, it hasn't reached the bear threshold yet,
Mm.
but like we're in that series of lower highs and lower lows on the RSI. So I was
Yeah,
curious if
yeah.
it's
So
reached as low as it is now, and then actually compared to the trend without you
yeah,
know
and
under.
and Kanye's like really big on this. Like, how often has it come down to this level? And um, she does this more with the composite index than with the RSI. But how often does it come down to a level and taking it as support? This is why Brian Swan uses this method where he defines the RSI per asset for both bull zones and bear zones. And so you can see, the times that it has not crossed that lower 40s level. You've got this instance in 2016 where it came down pretty low and it's testing its 10-month moving average. That instance in 14 where this version of the indicator sees it as crossing over, it's actually bouncing off of it as support, similar to 2012 and again in 2012. So, finding support at this level is pretty strong versus crossing it is when we are more likely to see a series of lower lows. So this could be, could wind up being a very deep area of value for us. I'm gonna pull up the composite index just to take a look at it. So composite index, for those not familiar with it, is like similar to the RSI, but it's not a bound indicator. Whereas the RSI moves between 0 and 100, the composite index can exceed 100, and it's taking like two different measures of RSI with a momentum measure as well. And the benefit of it is it picks up divergences in instances like this where the RSI does not, and that's because of the unbound nature of it. So in 2023 and in July, it's giving us this tight 2 period divergence and letting us know that we're going to experience this potentially going to experience this drawdown that we experienced in the whereas the RSI didn't do that. We're waiting to see it cross over and fail after it crosses a moving average. So in this instance, we can do the same thing and take a look at how often has it gotten to like a -4 reading and taking it as support. Um, let's see if that's an important level. It was like essentially the bottom in 2018 and was that shallow drawdown again in 2014 and in 2012. But yeah, it's looking like if we're crossing below this threshold, that's a much worse outcome for us than if we remain above it. Yeah, good question though. And then looking at the VIX, so is it safe for new buying? The VIX and its Keltner channel has signaled a local low for us once again, and so the Keltner channel, had its confirmed top and rolled over from it, and the VIX has returned to its regression channel, but the upper band of the Keltner channel is still above the regression band. So this is elevated risk for us, but we've got, a high in the VIX rolling over from it, showing us once again that we've got a local low in the market. Until the S&P gets back above the middle part of its regression channel, this is bearish for the S&P. Good. Let's see if I've got what's the next one that I wanted to take a look at. So taking a look at just overall trend health. So we're starting to see treasuries roll over a little bit, and that's probably going to that supports a movement higher in equities, particularly if the Dixie remains cool. Gold remains strongest in all time frames, though there are some signs that we're probably close to a profit-taking area or directly in a profit-taking area for gold. And then commodities are starting to pick up in the shortest term time frame. So, this speaks to a rotational experience for us. If gold is cooling off, we're seeing this in precious metals are picking up and other types of commodities, and treasuries cooling off a little bit is it's gonna show us higher rates, but should be followed by a rotation of funds from treasuries into equities again. Breadth looks pretty awful still, which we saw in the prior tab. So essentially, new highs, new lows are only green at the yearly level. And then USDT dominance, this is still looking bad for Bitcoin, and still, um, presenting us with a higher likelihood that we're going to get a lower high versus a higher high. If we do see a higher high, I think it will be this either this week or next week. And if we're going to see it in the near term, otherwise, I think that probably pushes off into the fall. And a higher high in Bitcoin should be accompanied by a rapid drop in USDT dominance back below this purple AVWAP. High yield credit spreads are again falling, and that's confirming the increase in the VIX. And the COPX curve for high yield credit spread has topped and rolled over. So this is a bullish sign. It'll be, it's a bullish signal, and the confirmation will be when the COPX curve returns back below zero. In terms of we talked about the consumer sentiment. Unfortunately, the data series on TradingView doesn't update timely enough, but continued deterioration in consumer sentiment. When we see this fall below the lower Bollinger Band, and the PPO oscillator for consumer sentiment roll over and have a bearish crossover and a cross below zero, that's the confirmation that we're entering into like an extended drawdown period for equities. And so, this is still on a bearish or a bullish incline, and the PPO is still bullish. So we just have to keep an eye on consumer sentiment. If it deteriorates consistently and quickly, that's going to suggest that consumers will not be. You won't see retail coming to the table aggressively for any of this market drawdown. And on the other, the other side of that is that consumer sentiment figures are typically distorted after, for probably like 3 to 6 months after a political party changes, after an election. So we're probably in for some negative prints on consumer sentiment for at least the next couple of months. And in terms of real economic variables, though, these are all of the economic variables that the NBER tracks for market, for business cycle timing and declaring recessions. All of this is still trending upwards. So this is, very strong environment, economically speaking. And the only one that's probably concerning right now is gross domestic private investment, and this does not update very quickly. So I think our next update for gross private domestic investment is next month, and that flattening out and rolling over is probably our first signal that we're going to start to see growth stifle economically. So everything here for the time being still supports optimism, and that doesn't mean the market's always going to move in conjunction with it, but it shouldn't deviate from it for too extended of a period. So that's essentially my read on it right now. And to take a look at where the S&P is. Um, so let's get back into to the standard S&P chart and take a look at the daily. So, the method that I'm using here is we've got a Gann timeline, and we anchor the Gann timeline to a confirmed low. And so we've got a low in October 13th, 2022, and the next higher low with a two candle reversal is October 21st, 2022. And that starts the calendar period Gann timeline. And so this is a square of nine timeline. So 3 times 3 is the first the first odd squared number in the data series. And so we start with 9 and it goes, just continually throughout, kind of like taking it out to like the 30-second level. But until we see the primary trend change, we continue with this timeline. These can be a bit distorted. The better way to align them over time is with a dynamic calendar that would include not just calendar days, but in linear time series, but also like a solar calendar, different planetary calendars and things that you can get a more accurate read on pivot points with. But at least in the initial time frame, the square of 9 applied to calendar days and market days has a really high coincidence, high likely to coincide with even like short turning points in the market, either trend into trend continuation or near-term reversals. And so then with each of these, we can look for an appropriate place to line up a proportional Gann box with a transition at one of the square of 9 timeframes. And so doing that, either queuing it into like a price high or a price low, like here in April 2024, we're able to find a grid that we can identify target levels with. And so the reason that getting stronger with the Gann methodology is so important is because there are a lot of ways for us to forecast price level, but Gann did a really fantastic job of forecasting timing with it. And if we can get timing and price level with probability of a high low, then we can plan our entries and exits on a short-term basis and even on a long-term basis pretty well. And so with each of these, here's where we get into the bear market drawdown from 2021 into 2022 in the same method that we're using right now. So the 5% drawdown signaled in this time frame. I'm going to turn this moving average off. And so the 5% drawdown signals in January 2022, and then we get, this would have been like kind of a whipsaw for us. And so we have to be flexible as we see the market try to recover from these. If we wind up in a situation where there's an orderly drawdown, we'll break above it. It'll look like a recovery. We want to re-enter on a retest and a successful retest. And this one looks like it's a successful retest at first, and then it fails, right? And so that leads us into our low where we start our timeline, and then we can see these recoveries. Your AVWAP is declining from the high, from the failed recovery, and then you've got your low. And so once we ultimately identify a low for us to anchor our green AVWAP, we're looking for it to squeeze with the one from the prior high. And so using that in conjunction with the Gann timeline, the square of 9 timeline and the Gann squares, we've got these levels where we can anticipate where we might see price line up with the AV WAP, and it's coming right up here into an angle. And we typically have resistance the first time that we test these. Um, and so, if it's going to resist, we're likely to head back down to the one from the low, and we want to see that hold the support. So, you can kind of plan the movement within these GAN boxes you know if your judgment has been accurate in where you've placed them. And it looks like this timeline has worked really well for us with the square of 9 timeline, and it's let us anchor GAN boxes to a number of locations that can help us plan price and movement. And so taking us all the way out to today, we've got our confirmed drawdown. We hide a little bit of this. So I was looking for, recall I was looking for this to make like an M pattern and fail into the lower AV WAP and meet resistance and come back down. So we saw that happen. It happened fairly quickly. And then we're coming up and we're testing the AV WAP anchored to the recent all-time high. And as expected, we're seeing a little resistance there. Now, what's interesting is GAN was very big on 50%. So you'll see people include 50% on Fibonacci retraces and extensions, like I've got it on this one. 50% is not a Fibonacci number, but it represents a point in the trend where the market is likely to run into some indecision and or a potential pause. And that's what GAN expected to see with the 50% mark. And that's why the center of these boxes is so important. And so you can see that a lot of times when we've placed the box correctly, you've got your pivot point at the 50% point in the majority of these, right? You've got like this, kind of indecision area. And then you've got your Fibonacci ratios to the right and left of it and above and below. So this comes up and fails at the lower AV WAP almost dead on to the 50% path on the way through the GAN box. And now it's coming up to this AV WAP. It's possible that this is, where we'll see this fail and make a move lower, but it just feels like we've got catalysts that'll drive the market's emotions in either direction for a little bit. We had the options expiration on Friday, the gap up from there. Got some economic data, some goofy news on text messages and geopolitics with Houthis in Yemen. So who knows what else will pop up throughout this week? But we've got those key economic prints coming out the morning of the 27th. Good news there could drive the market euphorically a bit higher, and then potentially a cool or unexpected reading on the PCE would reintroduce some uncertainty. So my bias is that we'll still see a move lower because this has happened so consistently when we have this many bear market signals. And my strong bias is to be bullish because it tends to turn out very well for us. And it's rare that the market is bearish for an extended period, but this many signals is tough to ignore. So that my bias leads me to think that we could see a movement even up above this AV WAP, but that it may not hold the support the very first time. Now, if I draw too many of these, so is this the one? No. Now, should that not be the case? Like what a recovery might look like is this holds as the low, and we get like a higher low scenario. It's very possible that we get a situation that draws out something like that is tested as support, maybe somewhere in the early April timeframe. We get like a tightening in here, and then start to challenge for like a new high. Um, that would coincide with like the strength into like um the early June timeframe. So we could see like these AVWAPs curl, level off, and then price come up, volley between them for a little bit, a break above, a retest of support, and then a springboard like that. That would be a really classic way to see price recover. And you can see, it's kind of done that in here in the past, right? This is what, this is kind of like the price behavior of recoveries. We should be able to find similarities elsewhere, right? In this case, you got the lower low scenario. But so that's a possibility, and we want to stay open to it. So if we do see, um, we see a price movement that takes its support from these AVWAPs, then I'll look to enter and put more risk on the table as we see that. And now this could happen like where we go back and forth in between them, and it stays indecisive for a really long time. We'll just have to see. How about you guys? What are you guys seeing or thinking as we've had this kind of bullish bounce this past week?
Everything I see is, well, I have my own biases too, but it seems like bulls grasping at straws. And, well, I showed you that my chart of the put call ratio is still like way in the bullish area. Like it hasn't gone anywhere near an area of capitulation like we
Yeah,
usually see. And also like well, I know the month isn't over yet, but the monthly MACD has flipped bearish, which but also like on the 2 and 3 week, the have closed already. It's bearish, and that like there's not a lot of false positive for that one. Um,
on
and
the
I
uh,
showed
on the monthly or the weekly MACD?
one. Well, the monthly is flipped, but I know the month isn't actually over yet technically. But like the 1, 2, and 3 week are all flipped also.
Yeah, this
Maybe maybe it was flipped when I looked at it yesterday, and now it's not today.
yeah though this is worth paying attention to though. So the um for the stock trader almanac guys, they do there's a best 6 month strategy, and I'm big on seasonality and the presidential cycle. But so the annual cycle, annual seasonality calls for 6 months, strongest 6 months for the S&P between November and April. And then the weakest 6 months between May and October. And so let's pull up the seasonality chart real quick. And so yeah, so on the S&P, I'll just hide that for now. Yeah, so your strongest 6 months end, about here in April, and then your weakest months begin. You've got two pretty decent months for the S&P in between. July is a very strong month, and it's the strongest month. You'll recall, like we get a ton of media talk about the summer rally, and maybe this is going to be a really strong summer. Stocks are really bullish, and it's like CNBC seems to get everybody to forget that this shit happens like clockwork, and then the market draws down in August and September. And this coincides with third quarter corporate tax payments and some activities that take place in the Treasury General account. So it's kind of a contraction in liquidity this time of year as well. So that's very consistent. And so on the 4 year presidential schedule, The Stock Trader Almanac guys will use the monthly MACD, and they use a regular MACD, but they use the monthly crossover on the MACD as the signal to exit during that seasonal period. So even though we get into April and then May, and May would be the first month of the worst 6 months, they don't actually exit anything until they get that MACD crossover. And then they wait for a positive MACD crossover beginning in October to re-enter. And the other strategy that they use is a 4-year strategy on the presidential cycle. Um, so my alert's going off that we should probably take a look at Avalanche in a minute. So they get the on the 4-year schedule, they use the 6 month rotation in years 1 and 2, and then in year 3 they enter when the MACD is bullish leading into October, and then they stay invested in years 3 and 4 of the presidential cycle, even in the worst 6 months, because those still tend to outperform during those 2 years of the cycle versus the first two. And so years 1 and 2 are the weakest in the presidential cycle, and they exit around this time of the year. So seeing a crossover on the monthly is also another indication that we're headed into like a consolidation period. And I'm highly skeptical that we're seeing uh so much bullish movement from altcoins and crypto right now. So here's Avalanche, still below the AB West from the last time that I drew it out. Let's see. Nothing that I'm excited about there. But yeah, the so you've got what we're seeing in altcoins right now though is you've got a lot of these you got a lot of these bullish divergences on the momentum indicators. So we're probably, this supports us seeing a pretty decent move up in crypto and alts probably in the next couple of days, and that'll be likely an exhaustive move. What uh what else from you guys? What else are you guys seeing?
Hi, so this is Tormod, um,
Yeah.
or JF. I'm kind of a little bit, I wonder a little bit whether the trend signals have a slightly different interpretation these days than they normally have, because there's much more, let's say, changes in the regimes, economic regimes, and much more noise. And the market seems to be much more vulnerable than it has usually been. So my feeling is that one needs to interpret small swings and so on more conservatively than one would usually do. Because, I mean, so next week we may get a bunch of new tariffs. And as you said, who knows what kind of news we're going to have during the weekend and so on. And so our data, if you go back 5 years, 8 years, 10 years, they are sort of generated in periods with much more stable economic regimes. Now we are experiencing a regime with a lot of um, instability, uncertainty, and so on. And we're seeing a bunch of money leaving the markets. We see American money going to Europe and other markets. We have seen for a while money moving into gold and precious metals and copper and so on. So it's a kind of different regime. So I'm I'm more cautious in the interpretation of, say, a small MACD crossover or something like that for the moment, because it seems to me that all those indicators, in a sense, are more fragile than we are used to them being if we look back a few years. I don't know if you think something along those lines.
I do too, and it's the crypto space is fun because you can do very well in it, but it's also there are a lot of people in crypto that are like, just really narrowly focused on crypto. And what I'll see there is exactly what you're talking about with what analysts and technicians are doing with the American equities and technology stocks and things like tech stocks, where we're trying to look at these like routine indications of a pullback and a bounce that we would see in an extended bull market or like in the middle of a bull market, and not treating them the way that we would if we thought that the market might be topping and rolling over, where they're like, celebrating a near-term bounce without considering how much volatility and uncertainty the market's still going to be presented with, and how quickly we saw a lot of money leave the market. And money leaves the market that quickly, um, and doesn't come back at the same pace. That suggests that that there is a regime change that we have to consider. And I'm seeing like just the parallel with crypto is stuff like this where you've got this bullish crossover below the zero in the MACD, and people will look at this as a buying opportunity, even though altcoins are doing this, right? They're um, they look about as bearish as they can, right? You're below your trend lines. And so yeah, looking at the what's the asset under management? I think we looked at this last week on our last call, and at the time, you know, our short volume, our assets under management in the short ETFs has actually picked up a little bit. And in the prior drawdowns, it got up, about like 30% at least, 20 to 30%. So it's like it's almost, the magnitude of change that we would expect to see. Um, but it still has not, I still feel like um we haven't seen we've seen like an indecisiveness in sentiment without it's almost like sentiment has not realized that it hasn't appreciated like the gravity of the situation, right? That we've fallen to a lower trend line, and we're now resisting at a trend line that is flattening, right? This is a very, very much a change in character for us to fall below a trend line, hit another one, and then bump into resistance at a flattening trend line. Um, that's not a bounce and recovery into an upward sloping trend line like this is. Um, it looks, a little bit more like this. Um, and I agree with you. Like when we see flattening trend lines and resistance into them, um, we don't want to feel the same way that we do about short-term MACD crossovers that are like short-term bullish. Yeah. What else? Are there any individual charts that you guys want to take a peek at? Yeah. I don't see a lot these days that I'm real excited about trying to work with.
So, can you say a little bit more about gold?
Oh yeah.
I have moved, or we have moved, um, into gold um, quite a bit, and I'm interested in what you said about it maybe topping.
Yeah, and I don't think this is like like I'm taking profit on gold. There were some technical signals that suggested that we should be doing that like late last week. And so, gold's one of these assets. It doesn't you don't get a lot of channel breakouts with gold like you know, like uh like if we're looking at the triple Qs and we do a regression channel, you'll see us like break above and below and below. Like you don't really get that with gold. And so when you bump into the top of the channel like this, that's more likely to be a point where we'll cool off. I also, when I forecast, I like to use these proportional movements for a forecast, and so you've got a basing pattern, and one of the thoughts is like the wider the base, the higher the space, but actually like the height of the base from trough to from the bottom to the top. When we break out of it, we should expect to see a proportional move, and likely it'll take about 25% of the time that it took um, to form the base to hit that proportional move. And then once you get that move, once your forecast is complete or hit, you tend to get another consolidation. And so we've seen that play out, um, three times prior with gold. And so we've got like a little consolidation here. And then if we did another another measured move right here, we would see the same thing, right? So you've got this small base that formed between um, February and between like January and February, and we break out of that base, and we're close, right? So that would have called for us to see, a move to around like 30.75, 30.80, and we've got a wick high up to like 360. So I'm not bearish on gold, but I think that, there's a chance that we get like a mean reversion back to the middle of the channel, potentially even the lower part of the channel. But that's still only a move down to like, 27.75 to 29.50. I would take those as buying opportunities. I think gold is a strong place for us to be with this much uncertainty on the global stage. But in in the cycle, what we see in terms of funds flow is, a top in treasuries, then a blow off top in equities. Gold ramps up during the entirety of that move, and then we start to see funds flow from gold into commodities more broadly. And I think that's why we're starting to see the precious metals pick up right now. It's a very slow migration into commodities, but we're starting to see a little bit of it. So I don't take this to be, bearish for gold. I take it to be an opportunity for profit taking and to be ready to to buy like towards the middle of this channel.
Okay, makes sense. Thank you very much.
Now you're welcome. And if gold's it's a slow moving asset, it can frustrate a lot of people. This is a decent ETF if um there aren't many leveraged options for gold if you're looking for a leveraged option for it, but I've done some trading with DGP, and I would look to let me do like a new fib crossover here. Yeah, I would say if we saw if we saw gold retrace to, so this is the DGP ETF. If we saw gold retrace to the 382, this 79.30 level, that would be where I would look to personally reaccumulate in the ETF. And yeah, in particular, it's like starting to line up with a movement from the AVWAP from the low. We'll move this one over to the high. Oops. Yeah, so if it pulls, I actually honestly anything in this area looks good for like a retest into this area would look pretty enticing for DGP. If you're looking to like um hold your gold position longer term and just do something on like a trading basis to help fund it. Yeah, you've got this AVU up from the December 18th low, turning right into the 382. That's like a prime opportunity to reaccumulate for my system, anyways. That's good.
Sounds good. Thank you.
Hey, you're welcome. And then I know silver's done really well, and I think from the way that I've charted it, probably still has a lot of opportunities. So be looking for like SLV to probably um be up into this like 32 to 33 range before it's fully exhausted or ready to like come back and test the top of the base. Um, that could be a move that carries through to October. It did have a couple of interesting things pop up on alerts today. KNSL, I know Aaron's big in this one. KNSL has given us quite a bit of a signal lately. So I did a couple of GAN boxes for it. Taking the GAN box from the 155 low that it hit in March of 21. Looking at it on a daily. Yeah, looking at the timeline with the GAN boxes for this one, you're starting to get like a triangle in KNSL. So this it's a strong insurance name, and insurance has done really well. But this, we could be looking at like the end of the insurance move by the early July timeframe would be the center of the GAN box. And the center of the GAN box um, in 2022 is where it put in the higher low just before finalizing that base. Um, yeah, so we could be looking at a situation where we make like a lower high into like the 507 area by the middle of this base and then start to decline towards the 50% mark back down to 350 by that's like a 2-year timeline though, so it's not one to worry about imminently, but yeah, this points to an opportunity for insurance that probably carries through May to July. And then I noticed that GE popped up today. I'd been looking at a lengthier move on a longer term move on GE. So this is a much longer term forecast, and I have not done the timeline for it yet. But the I think they had news today about opening opening a new facility in Europe to maybe support some military uh, military construction, military equipment. I have to read more about that, but that could be the catalyst that pushes it up to the 1.272, potentially even to the 168. I would expect us to see like a corrective move in between, but GE continues to look really strong. And before this move is done, we should expect to see a new high challenge as close close to what we saw in the early 2000s to late 90s. Skyward, another specialty insurance company. This one, it's a weird looking chart because this is a newer listing, right? Yeah, I don't know how so you've got like kind of a cup and handle that's formed and breaking above like a triple top. Uh, yeah, so we might have an opportunity for SKWD like around potential for a move up into like the up into like the 61, 62 area. And it's currently now at like 54. So I'd say, there's very few things that especially in like US equities that have me terribly excited right now. So if we do see them, I'm going to take them with a lower position size and be a bit more cautious on my stops. So I would look to like take profit into something like this, um, just ahead of the 1618 and probably cut it short. That's just my style, especially in markets that are pretty indecisive. And then um, the ATR on this, so 50% of an ATR is about $1. And I would look for, if I'm looking at this move, I want to see it. This wick high is called like a high wave candle. Like, well, it's like an inverted hammer almost, right? So this tells us that the stock is made a new high, but it didn't close at that high, and selling was exhausted. So that's a risk for us, but you've also got an open and close above the prior day's close. So with the bullish candle, so this is still a bullish opportunity for us, and I would be looking for maybe something like maybe something like that, and I'd be looking to join it on this like retest of the base. So somewhere around like 54, and then I would look at um, probably look at like yeah, probably look at like something like that as like a failure point. So yeah, like the insurance names look decent, but if and this is like a newer, more speculative one. If we see this bump and jump up and retest, so we come back in with a candle that covers some of this wick and some of this prior high territory, and then a retest around the 54. I like that with the stop, down lower. And again, this is just how I would do it for myself, not advice for anybody. And then taking um, profit like aggressively prior to target. But yeah, that's a decent looking like 13% opportunity with the 2.5 to 1 risk reward. That's kind of it for what I've got on my near-term radar. I know in the last article we had Sony. Yeah, this move still looks pretty good. I like that it's got a lot of distance in between now and the next time zone. Yeah, this looks strong for like a good movement into like the July timeframe is really strong for Sony. Yeah, like 70% win rate in the month of July with an average of 3.4%. It's the second strongest month of the year, and a good international name. So unless we're going to have a brutal tariff war with Japan, but we don't. Does not look good. I know we looked at Pindo Duo. The feel like there's a lot of attention to these Chinese names, so these are probably a bit riskier. I'm going to play this stop pretty tightly in this one, and then the EZPW is a leasing company, and like this is just a beautiful looking base right here. And notice that like this is done well um, in more volatile. Let's try with the VIX. Yeah, so in volatility regimes, like in the 90s and where we had this like series of like higher lows in um into higher lows in the VIX into a downturn, right? Like that played out very well into the from the mid 90s into the late 90s for EZPW. And so this is an environment where if we see credit spreads tightening repeatedly and continued volatility spikes, this one probably continues to do pretty well, and it's just now retesting a multi-year base. So if it breaks above this, I'm looking for like probably like a, I had thought I had done an estimate on this one, but it's yeah, a break above this base probably takes us into about like 1760 to 20. Um, that's not bad. That's like, good 20 to 25% opportunity from the top of the base. And conservative way to play it, I'd look for like, a break above and retest. I'm in it now, but there just aren't that many things that I feel strongly about right now. And this has a potential just due to the rest of the environment for it to go very well. And then you've got this um, you've got this kind of favorable bullish divergence supporting or bullish confirmation in the momentum indicator supporting price, and we've not made like an extreme in the indicator yet. So if we see the indicator, if we see like the MACD, the volatility normalized MACD push up to like 150 to 200, then we're probably close to the turning point for the uptrend for this. But again, like just see these basing structures with a series of higher lows and approaching the top of the base. That's a pretty bullish look. But yeah, that's mainly. Oh, let's take a look at Bitcoin real quick. So Bitcoin is moving like almost exactly as I anticipated it with this can box. Um, we're moving right into actually have not updated this this drawing for a little while, and it's rolling back like right at the 25th as it hits this next peak in the box. So I do think if we were to see a bullish move through the 27th to the end of this week, it probably takes us up to about this like 96 level. Um, and runs into this angle up here. Like it could be a scenario where we get up like this high, but we don't in a descending descending wave pattern, like an ending diagonal, we could move back above this wave down, or we could be looking at like a zigzag type of pattern. But if we do get much higher, it's probably either going to fail into this AV WAP or into this into this next angle in the GAN box. And then my lower target for it would probably be down here at this next green AV WAP, like where it starts to come up and meet the next level in the GAN box. And we can see again, um, in this GAN box, we broke out of a base right at the 50%, halfway through the GAN box. So this one's anchored pretty well. It's anchored to the 441 time period on the square root of 9 timeline, and a lot of our pivot points have lined up with that. And the next one is mid-May. So not a great look for Bitcoin, like likely near the end of the near-term uptrend for the cycle. If we do get this other, another high, probably into the fall. But that's what I've got on my radar for right now. Anything else that you guys want to take a peek at?
Hey Ben, would you mind doing copper
Yeah, absolutely. Do you do the just the straight
or
commodity?
CPER or whatever, the ETF or some
So yeah,
just one.
so COPX is the miners, right? Yeah.
Yeah.
Do you do the miners or do you do CPER?
Um, I do CPER. I do COPX for since it doesn't have a K1, I'll do that one for my um,
Oh, yeah.
yeah, for my 401 or my qualified money.
And some of the
But
small.
this one, I for some reason want to just keep getting out of it, but it kind of just keeps bumping higher and higher.
Yeah, commodities especially the metals. The tricky thing with commodities and for all of us to be aware of with I think we'll have a strong opportunity in commodities, but one of the things that we need to be cognizant of is that they're one of the few asset classes that's more consistently in a bear market than a bull market. Um, and so it's important to take profit along the way. But this is a great looking like break from a base. We can see that it's had trouble with it before. It's interesting how a lot of the volume for copper is at the price high, right?
I just remember last year, I think it was around May, I remember jumping in and riding it all the way up, and then I think I rode it all 90% of the way down. So I'm trying to avoid that same thing this this year.
Yeah, absolutely. So yeah, we had that you get this steep sell-off in 2022. Let's take it from the gap. And so this is yeah, this is kind of risky. There's been a lot of attention for copper recently, and right into this 1.272. So sometimes that's where an uptrend terminates. 1618 is a strong place for a bounce in an uptrend or a downtrend. And let's see what copper's respected in the past. So we've got rollover from a momentum high into a low. Oops. But this one, all the way up to like the 200% extension before exhausting. Here. That's a 200% extension from the drawdown from the momentum crossover in July. So I'm going to say this is probably a good area for profit taking on copper. I don't know if this is going to. I mean, there's a good chance that we continue to extend higher if we take like a proportional measure. Um, I would do that from probably about like. Yeah, like a proportionally measured range. In the way that I do it consistently would call for us to see this ETF up into like the 34 to 36 range. But I might, if I'm being conservative, I might try to take some profit on that a bit sooner. I don't think I have anything open for copper right now myself, unfortunately.
Got it.
But yeah, that looks like a pretty good if if I had a full position, I might take like a third proactively, and then let's look at it on the lower time frame. Yeah, the trend is still really strong, and you've got um nope. So your all of the AV WAPs are looking really good for copper still. It's below its 2-day, but the 2-day AV WAP is below the weekly AV WAP, which is okay, and because it's only Tuesday, but yeah, it's so price is above all of its AV WAPs, and when you've got your daily above your 2-day, that's a bullish condition. So I would say if if you were to if you wanted to like if it was me and I was trying to like proactively take profit, I might take a portion here, and then maybe a third I would set as like a stop below this second low back here on the 21st. So your second higher low back here at 31. So if it's turning over, so you've got on your 30-minute time frame, if this was like an ABC and like the end of a movement, you would know that if like the 2-day AVWAP fails or the 2-day VWAP fails and then you get past 3140, then it's, you know, then you're looking at like a move that probably comes down to like,
Yeah, down farther there. Interesting.
yeah. Yeah, and that's getting us like almost all the way back down to the base, which then coincides with this first shelf on the volume profile. So that's like probably a pretty good estimate for like what a failure in copper in the short term would look like, and where I would look to probably personally like add a little bit. But yeah, so if you're looking to protect the position that you have, this area below what we would call point A is probably a safe place to put a stop, and then you know a corrective move shouldn't fall below. This is like the year to date AVWAP, like it shouldn't fall below this level.
Got
So,
it. Cool. Thank you.
yeah, you're welcome. And then if you look at um, let's see. So I don't. Do you guys have a good ETF that you use for Australia? There we go. So like there's a lot of mining companies in the Australian market. And if you know if copper is going to remain strong, then you know the we should see we should see EWA come back up to like 2640. So that'd be our confirmation if like EWA is headed into like a more of a corrective move, then that means copper probably is as well. And so we want to see the EWA, you know, pick up, probably re-challenge this like 2630 area. Because this should play out more like a um uh,
Is MVR, is that like M is in Mary?
oh oh yeah. What's in this one?
I think they have like the Rio Tinto, Woodside, BHP, I think. I don't actually know exactly what's in there, but it might get you a little closer.
Yeah, it's an international ETF, right? Yeah, it's on the ASX.
Yeah, yeah.
Yeah. Yeah, that definitely so you got a higher low, um, but that's definitely, you know, descending line. Let's see if the Aussie dollar picks up a lot of strength against the yuan as well. So typically, like this, you know, this is a good signal if the world economy is doing well and the Chinese economy is has high demand for copper for manufacturing. Um, you would typically see the Aussie dollar do well against the yuan. But the Chinese economy has been a little bit rough, so it may not be as strong of a signal in the near term.
I think copper is used a lot in electrical vehicles, and it's also used a lot in data centers, I think.
Yes.
And so if all this building of data centers and so on is going to happen in both in the US and in other parts of the world, and the expansion of electrical vehicles continues, there's a good case for high demand for copper for at least a while, unless we get trade wars and customs and so on copper, I guess.
Yeah. Yeah, I agree. I think the demand for it is and the problem with it is like when there's demand for precious metals, the it just drives price up because the ability to mine them more quickly um is requires a lot of lead time. But this I think the Aussie dollar against the Japanese yen is this is a strong sign that um that copper is doing well. So the if the Aussie dollar is strong relative to the yen, that supports a move up in copper. I think oh, it's a little noisy. The miners look strong still.
The miners, and I don't understand the relation. Well, I understand, I guess, kind of the relationship, but I don't understand why copper is. I mean, it seems like COPX is kind of more subdued, or it's just just taking longer to kind of kick in. But it looks like it's, prime. I mean, I don't know. It's a lot more comfortable spot to maybe buy in at versus copper.
Yeah, it's a weird thing with the metals. Like you think about it like if you're into Bitcoin, like when after the halving, um the cost to mine goes up and the price of Bitcoin goes up, but the miners have to sell Bitcoin in order to fund mining, and so it can actually drive uh, the costs of the commodity can actually drive the cost to mine um, higher as well. And that happens in gold and other precious metals as well. So as the price goes up, initially it's more difficult for the miners, and then as the commodity reaches like a sustained price level, the miners start to pick up as well. I would look at like for COPX, a move above this 786, the 4440 level, would imply that we're going to see a a move up to about 4877. So I would look for that as the confirmation for us. That's like my go-to move is you get above this 786 with a
Mhm.
little retest, and then I'm looking for a relatively short play right into the 1272. And in this case, that lines up perfectly with the point of control in the volume profile. And and right now you can see it's like running into resistance right at the AV WAP. So this is like classic type of move. And I'm gonna keep this right on my radar. So I like this for myself. I would look at it as probably like a 2-to-1 risk reward on like a 10% opportunity. Looks pretty strong. But yeah, it's gonna probably see some resistance right at the top of this volume profile. Um, and then curl back down to the 786 before a move higher.
Yeah, no, I like that.
Yeah, and honestly, like if it stays really bullish, um, sometimes I'll do like, a 1/3 entry on the breakout and 2/3 on the retest, just so that I'm not I'm not stuck. Because if this gets too far away from you, and you're now entering up here, like you can't really put a strong stop in. You've got to put your stop somewhere into like normal price action, and
Yeah.
and that gets too risky. That's what's good.
Huh, very cool.
Yeah, and this this is exactly what we want to see is you've got, a long-term lengthy like bullish divergence um in between momentum and price. So you've got a series of like lower lows in price but higher lows in the momentum indicator, and that suggests that we're going to see like a momentum breakout.
And how do you, I mean, if you start seeing like, I don't know, a divergence between like the miners and copper I mean, like, I don't know if it happens too often, but at some point it seems like they kind of go, I mean, there's some correlation, I'm assuming, but, if say copper is just tanking and then COPX is starting to go up, is that like a red flag or is that a positive thing?
You know, I I'm gonna have to spend some time looking at it and see where we might have experienced that in the past.
Yeah, because yeah, I'm just in a weird spot of, yeah, like I probably just need to stick to one or the other because um,
Yeah, I because these like it doesn't, you can see that like the um in an expansion like this, you're getting these big jumps. So like the miners should be high beta to the commodity itself.
yeah, that makes sense.
And so if you're, you've seen a turning point like with copper right here, you've got like a break from a base, and we still haven't completed the base for the miner. So this is like a really strong speculative opportunity to participate with the miners. But then if copper rolls over, um, like it does back here, the correction is much more violent in the miners than it is in the underlying commodity.
Interesting. Yeah, no, that makes sense. It almost seems like sometimes they're playing catch up, but then
Yeah.
they're more, yeah. And I mean, I guess is that probably similar for like GLD and GDX or whatever? Is that is kind of a similar relationship,
Yeah, absolutely.
I would assume.
Yeah, because in this
Oh
like
wow.
yeah, the cost to produce the cost to mine gold goes up as the cost of gold goes up. But you can see this almost looks like you've got this this period back here leading up to the
Hmm.
breakout is
Oh
almost like
wow. And
it's almost like the same thing that we just saw with copper. Like you've just completed the base, and so we should expect to see a movement from the gold miners that's relatively similar.
I mean, if you're waiting for a pullback on gold, would it be, I mean, it almost looks like GDX might take off a little or might have an entry sooner than gold, maybe, or no?
Yeah, it could be I mean, I think it's a good speculative opportunity, especially if you've got a position in gold and you don't want to you're hesitant to take profits on it. Something shorter term on the miners. I tend to be not as big of a fan of the the mining ETFs, I just take my profit on them like very, very aggressively.
Yeah.
But I'm like emotionless about getting in and out of it, whereas gold is something I'd like to accrue longer term. And I tend to be more hesitant to take profit on it than I should be. So it's easier for me to, just set a stop and stick to it with the
Yeah.
miners.
Well, the miners I can see. I mean, just oh yeah, that's a daily. Yeah, I mean, I can see it looks like two. If you wait an extra day or two, it seems like you could just lose all your profit.
Yeah,
Miners.
yeah, they're definitely
So,
high volatility.
yeah, very cool. Okay.
Could you look at Palladium?
Oh yeah. Where everybody's gonna find out that I can't spell palladium. Yeah, let's see. Palladium's
Oh, interesting.
I think of where I saw the move in palladium, where it caught my interest. What's the Palladium ETF? Is it PLLT?
PALL.
So that the Meb Faber article.
Oh yeah, the one you shared today.
Yeah. So this is interesting. Like when so if you guys haven't read this, a quantitative approach to tactical asset allocation, you know, Meb wrote this paper. He was on the stock market TV segment this morning. They had an interview with him, but he's a CMT market technician, and he wrote this paper, the first version of it in 2006, because at the time the CMT would accept a paper in lieu of taking the test, and he didn't want to take the test. And because he published this before the market meltdown, and the approach would have protected you in the during the Great Recession, it it uh, it really put his career on a pretty strong path forward. Brought a lot of attention to it, but he this paper is like very, very straightforward in terms of like trend following, and he's looking at um, a monthly chart that's essentially the 200-day moving average at a monthly level, and using that as your sign to enter and exit, and it's protecting you from like these massive drawdowns in the market over time. And so the assets, it doesn't necessarily outperform in the uptrend, but the outperformance comes from not experiencing the full drawdown of an adverse market downturn, which is what we're trying to do here as well. But so this paper is worth checking out, and I ran this just simple like 40 or simple like 10-month moving average, using the crossovers as the opportunity to open a position and then exit, and then looked at that against a bunch of industry ETFs and individual positions that I had on my watch list. It produced I'm just looking at the stats. It produced like 75 wins and 50 losses out of the positions that I looked at, 125 different ETFs and stocks. 120 or 75 of them were net winners over 4 years, and 50 were slightly net losers. But the winning positions generated 64% annual performance. And if I exclude Bitcoin, um, if I exclude Bitcoin, then it's like 14%. So Bitcoin's, if you have a massive winner in there, it's gonna, especially if it's a large dollar amount, it's gonna skew it pretty heavily. But but yeah, long story short, I looked at which one of these things were consistently losers that also had a lot of activity. So a lot of the winners, when you look at entering on a 10-week, a 10-month moving average and exiting on a 10-month moving average, there should not be a lot of whipsaw on a 10-month moving average. And the Palladium ETF is one that had an annualized 10% loss and um, and had 13 signals to enter and exit. So, as long story short, that like makes me a little bit cautious on Palladium as a as an opportunity. And I don't like gold and silver and copper. They make a lot of sense to me. I don't know enough about like what would drive. Like I'm just not a precious metals expert, so I don't have a very good read on it, and it seems to have a tough time with some of the other technical tools. So um I might defer to like an XME or like a just a precious metals and mining ETF, like just a broad sector thematic ETF to pick up exposure to it. But yeah, it's yeah, and so on the weekly, yeah, you've got like that flat MACD, so this suggests like more consolidation, which yeah, it's a tough thing with commodities, right? So even here we have like a big, spike up. Yeah, Palladium could frustrate us for a while. I just don't have enough. Do you have like a read on its industrial uses and what its demand would look like?
Oh, I think it's used in hydrogen cell for like hydrogen vehicles, and it's
Is,
also used in this.
is it used in catalytic converters?
Yeah,
Yeah. So if we start to see memes about people stealing catalytic converters again, that
well, you know what? They because I used to uh, and I recycled a lot of old catalytic converters, um, but they actually made it so that it's really hard to do that now
yeah.
because you have, because I'm stealing them. Um, so I wonder if that'll cause like a supply crunch. There's less recycled material coming in.
Maybe at least like a supply of the memes will crash. But I swear, like if we do see a bunch of memes about theft of catalytic converters, I want to find out like when those were popular and then compare it to the Palladium chart.
It was in 20, 2021.
2021. Yes, that would have been like right here, right? Like,
Everyone was stealing them off of the brand new cars in the dealership lot.
wow. Yeah, that's right here, right?
Yeah.
Wild. Yeah, on that back test that I did on looking at the assets that lost over the last 4 years and the ones that had um a lot of signals, like more than 10 signals over 4 years. XLV was one of them too. Actually, COPX was too.
That did well or did badly?
Was ran at a net loss
Oh,
over the time series, and then also had a lot of signals. But that means that that's also not the right signal to use the 10-month moving average.
Uh, it's just so beaten down and like on its lifetime chart
Yeah.
on a log scale. It's like at its long term trend line. So it definitely seems speculative, but man, it's so beaten down. Like if something happens that drove the price higher, it'd be pretty interesting.
Yeah, that is wild.
It's seems like it's the most levered to the like S&P um, uh, compared to the other precious metals.
Mm.
Um, but obviously didn't join in this last bull run.
It's not getting squeezed, is it? Y- Um, Here's one that keeps coming up on my screener lately. Have you guys had any experience with Lemonade, the insurance company?
Are they profitable yet?
Probably not. Yeah, so you've got that failure at its AV up from IPO. So if we get like a cup and handle formation out of this, we would need to see that. I would personally, I would need to see this like I don't know why I keep like I don't it's in a momentum squeeze right now. So a break from it could be favorable, but you know, I'd look for it to like break above and retest before doing anything with it. I screened for my watch list to see if any of the metals popped up, and I didn't see them. And I just noticed this one did. And then from an international perspective, this is an ETF that I'm in right now, the Swiss franc ETF. I've got a really small position in it. Um, but if when US dollar cools off, let's compare it to the Dixie. This tends to have a pretty inverse relationship to the Dixie. And so if the Dixie's headed lower, then we're likely to see a move higher in the Swiss franc. And but I would probably like I would plan to sell it into the 786, like at the 102 level is where I've got my take profit. And then failure below this A view up from the prior high is where I plan to exit on a stop loss. But yeah, Swiss franc looks pretty decent. And this we could make an argument for completed correction here, and this and then the um remains to be seen if this is going to be like if this is the conclusion of wave C up into the 618, which is why we want to use why I'm using the stop so tightly down here. But if this is like, ABC up, then we'll head back down to the lower portion of the channel. A break above this level should come into the 786 before hitting the center of the regression channel, and then making a decision point from there. But any weakness in the U.S. dollar is a good opportunity to keep the Swiss franc on the radar. Do you guys want to take a look at one more? Exhausting everybody with charts.
Are you looking at anything like energy related?
Oh yeah.
I think DBT has a lot of energy.
Yeah, I actually really like energy right now. And so I added to XLE today. And I think we've got a strong case for yeah, so XLE, again, this is my bread and butter, right? Like we've got to move back above the 786, and you've got three attempts to cross the 786 right here. And so today, these past couple of days have been the third. You've got not real wild about it closing with a doji today. So it's possible that that's an evening star, which will send us back down. But closes above the 786 like this, I'm going to look for a movement in XLE up to the 97 to 98 area. Again, I'm going to take profit on anything that I can pretty aggressively right now. And unfortunately, I've got to keep a stop lower for this one, give it enough room to get back below the 618. But yeah, XLE looks good. We've got the bullish crossover and the histogram crossover on the MACD, and I'm going to set this RSI back to look at the on balance volume. Got this a lot on there. So on balance volume is a look at just volume plus minus, and so it's like a running accumulation of volume, assigning the day's volume for a positive close as a plus, and then subtracting it when there's a bearish close. And so we've got a bullish divergence into the low. Divergences are really powerful on balance volume, and then using an RSI of on balance volume can be a stronger indication of trend than using RSI on price in some instances. And in this case, you've got a bullish crossover on your faster moving average, and price, I'm sorry, the RSI testing that moving average is taking it as support and then moving higher. So this is a really bullish look in on balance volume for energy, confirming the price movement higher. And in cases where um, we're going to fail to and see trend exhausted, you'll have situations like this where on balance volume breaks out, and then you get a bearish move downward, and you cross below your moving average. Now you can see this crossover, this bearish crossover in on balance volume happens like well after we've gotten into the downtrend for XLE, but using an RSI of on balance volume told us that change was going to happen in advance. And so we have two bearish divergences on the type 2 divergence. You've got your moving average peaking, rolling over, falling down through the slower moving average, and you're losing both moving averages in one close. So this would have told us, in April of 2024 to get the heck out of energy. And here I wish I'd seen this sooner. You've got an RSI extreme oversold with a tight 2 bullish divergence and then running right back up through the moving averages. So this is a really strong showing from energy, and I think this has some legs to it. And then another way to play this, I've got both of these positions open right now. Is we've got the 2x bullish ETF, leveraged bullish ETF for energy. And this again, I'm looking to take profit into the 1.272, but same movement from now you're not seeing the divergences on the leveraged ETFs like you do with XLE, but you've got the same bullish retests and bounces on the on balance volume and a lower high on RSI, reclaiming your moving averages as support and all of them curled upwards. So a very bullish look for energy. And then I don't know if this chart's going to help us as much with gold priced as high as it is, but in the past, this relationship between gold and the ratio of gold to oil has been really helpful in finding market bottoms for energy. And if the price of gold divided by oil falls, so this can fall by oil prices going up or gold prices going down. If we start to see gold roll over a little bit, demand for oil, price for oil usually benefits, and that could be a turning point for oil. But it's harder to tell because gold is just doing so well lately, and a lot of times, like 2022 and 2023, this was much more reliable because gold wasn't trending up as strongly as it is right now. And let's take a look at energy exploration too. Energy exploration still, we've had a lower channel breakout, so this is a very bearish look for energy exploration, which if exploration is not doing well, then it's not going to be expanding in the near term. And if oil starts to do well, then performance in the exploration sector should lag it and start catching up later on. Yeah, but XLE looks pretty good.
What moving average lengths are you using on that RSI?
Oh, yeah, I think this is the 13 and the 33. So there's a 33 period EMA and a 13 period simple moving average, and then a 13 period RSI.
Thank you.
Yeah. Actually, I'm just curious to see if a 5 period RSI is helpful. Yeah, a bit choppier to use a 5 period RSI with on balance volume. But yeah, applying it to on balance volume is pretty strong.
Yeah, that's interesting.
Yeah, cool. All right. I think that's it for me tonight. If you guys have have questions as we go, if you see something in the signals or just a stock or sector that stands out, feel free to hit me up with a message, either Substack, any of the forums that I'm in. I'll be happy to jump on a call, do a video, or take a peek with you guys.
Great.
Cool.
Thanks, Ben.
All right. Thanks, guys.
Thank you very much.
Thank you very
Yeah,
much.
absolutely.
Have a good night.
Bye.
Take care. Bye-bye.
Bye.
He's very nice.